Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today owns over 124 units in 3 states, manages more than 60 units for other landlords in Southern California, and is an experienced syndicator and flipper. Omar Ruiz is the owner of LaRue Investment. Omar, welcome to Purchase to Profits. It's great to have you on the show.
Oh, thank you very much. It's great to be here.
Yeah, it's my pleasure. So to kick things off, tell us about your real estate goals right now.
Well, first, immediately, the goals right now is to build a portfolio of 1,000 apartment units.
Nice. And would you say
that's what we're striving for right now?
Yeah, would you say that 1,000 units was just an arbitrary number? Like, did you just say 1,000 because it's it's a nice round number?
Well, yeah, I mean, there's that, but there's also what I've heard too is that when you get to about that amount of units, that it makes sense to start having your own property management company to oversee those properties. I do have a property management company here in Southern California, but when we go out of state, it doesn't make sense to start or to have your own property management company unless you have a sizable portfolio, if that makes sense. So at about 1,000 units, it's a good amount of units where you can support your staff over there, and then you get some cost savings as far as the management. If you have a large enough portfolio and a concentrated market, you can take more advantage of some of those economies of scales when you do have your own management company.
Yeah, and what does 1,000 units look like to you volume-wise? Do you have a certain dollar amount of what 1,000 units will entail?
Well, 1,000 units, and I'm not really even saying just in one particular market, but I would say in total, across the country, and that can be, we try to target most now really we target more properties at least 100 units, between 100 and 200 units.
Yeah.
At those numbers, you have more economies of scale. You can support a staff and a payroll in there. So when I'm saying 1,000 units, it could be, 300 in Texas, another 300 in the Midwest, another 300 in the Southeast, and so those kind of things. And as far as routinely, the deals that we look at, the price per units are going to range anywhere from probably the low 40s per door to as high as 60s per door on units. So if on the low end you're looking at let's just say 40,000 per door on 100 units, then you're looking at a $4 million deal.
Yeah.
And that's on the low end. So from there, it's just going to go up. So
Yeah.
I guess anywhere. So I guess the bottom line, anywhere from $4 million to maybe a $6 million type of a transaction.
Yeah. And when you first started your company, did you have a goal to hit 100 units? Like what were you trying to accomplish when you first started out?
Yeah, absolutely. Absolutely. I wanted to get to that 100 unit level there. And it's kind of interesting because I remember a success principle that I was exposed to was, you have to have real belief in, what you're trying to accomplish there. Otherwise, if you have a goal that is so, crazy audacious that your belief level is very low, okay, then because you don't have that solid belief level that you can get to that point, you're not going to accomplish that goal. It's going to make it like an unrealistic dream more than a goal. Okay, so what I've learned is that if you compare things down to what something that's believable to you, or at least achievable, and you can get those little wins over time, that's going to help you to eventually get to that big goal. Because every time you reach a goal, you accomplish that goal, you're always going to be looking for the next thing and the next bigger thing. And it's kind of interesting because the property that I'm going to be sharing with you and your audience, uh, it was kind of interesting because the the acquisition of the property, everything went, fairly smooth, pretty smooth, and the due diligence and everything went was pretty quick. And I remember several months afterwards, I was talking to a friend of mine, and she's also a real estate investor, and I was telling her, it's funny because most people in my shoes right now, they would be very excited, and I mean, um, just a high, joyful, feeling, and it was like, and I didn't, I just didn't feel the excitement like I did with the previous deal for some. I don't know if it was just too easy or what it was, but and she just said, well, because you've accomplished that, you're really looking for bigger things now to do, and she was absolutely right, because the next bigger thing was really, kind of got my juices going, but. That's kind of something that I picked up on. If you pick this big, crazy, audacious goal, let's say, you want to start out the gates, you want to get 1,000 units, okay, but like I said, your belief level is not there. You haven't even done, 100 or 50 or whatever. Mentally, it kind of gives you a mental block, if that makes any sense. So it's really good to kind of get to at least an intermediate goal.
Yeah, I think that's a really good point. And lots of our viewers and listeners, they're either just starting out or they have a couple properties. Maybe they're at 50 units, and they're looking to make that next step. So, as you started building your business and your portfolio, what changes did you have to make with how you thought about real estate and yourself in order to hit that next plateau?
Okay, well, I definitely had to consider having more people involved in the projects.
Yeah.
When we were buying here in California, here locally, it was, and having our own management company as well, it, was a lot easier for us to be more hands-on, and just really run the operations and kind of see it from the inside and out. Going to some of these out-of-state markets, and working with third-party managers, we had to take into consideration, those extra costs. Now you have, payroll that you have to factor into the deal, and a lot of training. We do that. Okay, if we're good at property management here on our properties, and we take our systems and procedures and implement them, whether it's in Texas or, in the Midwest, Southeast, whatever, we're going to mitigate a lot of those risks. Okay. Now, I have had to fire property management companies, just some of them were just not a right fit. Okay. And so we had to let them go and bring in a better outfit. So those are some of the considerations that we do now when we're looking at these bigger properties, especially going out of state. We talk to property management companies and really kind of get a feel who's going to be a good partner on a particular property.
Yeah. And I'm glad you brought up the property management because, let's say somebody's new and they've never interviewed property management before. I think you're in an interesting spot because you've got the business on both sides of it. So what tips would you give to somebody for approaching a property management company and starting to learn about how they work?
Okay. Yeah, absolutely. So, well, I can tell you from my experience with the property management company that we wound up firing, okay, and why they weren't a good fit, okay. The types of properties that they were really, in my opinion, that they were kind of more used to managing, okay. They kind of had more of a mentality of if there's a problem, there seemed like their first impulse was to spend money, okay, and I don't believe in that. I believe in, finding a creative solution. Okay. And these guys just were not creative, not one bit. Their thing was always, okay, if if this is not working, okay, we got to find something else to spend money on or find another vendor. And it's really interesting, Seth, because I remember early on, and this is not something that the ownership is supposed to do, but early on, we saw what the landscaping bill was coming in at. And to me and my partners, we were like, you know what, that seems pretty excessive. We want you guys to find somebody else. Okay. And I flew out there. And it was kind of weird. It seems like they were kind of just, they weren't really, they were kind of skeptical, I guess, that we were going to be able to find some cost savings there. So I flew out there for a time period, and I actually interviewed a landscaping company. And it's funny because the guys came out, they had their uniforms and all that. And I remember the head of the property management company, he was there, and he was kind of disparaging them, saying, "Oh yeah, they're it was going to cost us more because they had all their uniforms on and all that." Well, to make a long story short, they wound up being half the cost of the guys that they were paying for, that they had on there. So I said, okay, go with those guys, and done deal. That's it. So those kind of things, your property management company should always be looking at how to help you run your operations as efficiently as possible. And that's the thing that these guys lacked. They weren't the bottom line, what was going to be the most efficient or most cost effective. It seemed like they were more focused on making their time, how should I say, easier for them.
Yeah, no, for sure. So
That's it. And when we finally,
sorry,
and I was just going
I
to say, when we
interrupted you.
finally,
Sorry.
yeah, no problem. But I was going to say, when we finally did find the right property management company, Seth, it was a good fit, because these guys, they were creative, they were cost conscious, they weren't necessarily cheap, okay, but they were cost conscious, and they were creative in finding solutions. Okay, it wasn't always a knee jerk reaction to spend money here or spend money there. It wasn't all they just had that creative sensibility, and were just more cost conscious.
Yeah. And so do you have any routines that you follow, maybe daily or weekly, that helps you stay on top of stuff like that?
Well, I do try to have regular conference calls with the on-site team. We also review the financials, the rent rolls, just to make sure the operations are running, sound and running good. As far as other personal routines, I did start kind of carrying a little planner. This was a little interesting little planner. I don't know if you can see that, but it's actually a paper planner here that I've been kind of experimenting on for the last 6 months or so, I think it is. So it's kind of been very helpful there. But yeah, you want to stay in constant communication with your team. We were just talking a little while ago with one of my local handyman guys here, and he was telling me he was talking with one of our property managers about a repair they're working on, and so I just kind of want to get more understanding of that kind of stuff. Because really, as an operator, and I kind of learned this in my background in aerospace. It's unreasonable for a person to know everything about everything. Okay, but you do want to try to learn at least a little bit of a lot of things. Okay, you don't need to necessarily know how the plumbing guy is going to install a plumbing line or whatever, but it is going to help you to at least know, okay, why is it taking him so long, or why does it take him so much time? Why does he have to use certain materials? Why certain materials are better than others? And at least know those differences. Okay, so that when you encounter that same situation, or maybe even not that same situation, but something similar in the future, you can kind of take um, those same fact-finding activities and try to get to the root of why something, functions the same way or costs the same way. Um, so you just kind of want to know as much as you can about a lot of different things. You don't have to know, everything down to the nuts and bolts of it, but at least have some kind of general understanding.
Yeah, that's some really good advice. Is there a keystone deal that stands out? I know you want to talk about your 32 unit deal.
Yeah, I was going to talk about the 32 unit deal because we did something very special and interesting on it last year in 2018. And this is a good thing for your listeners to understand about, building wealth for the long term. Um, Now, real estate is a way to build wealth. Okay, but if you look at it as, you want to build wealth, fast. Okay, it's I don't think it's healthy to have that kind of mentality when it comes to real estate. And you may have even heard people say it's a good way to build wealth slowly over time. Okay, and that's really the best way to do it. It's not a get rich quick scheme. Okay, it's not like that. Okay, but you can do it, over time. This particular deal, we were able to refinance it last year in 2018. And with that refinancing, what we did is that we were able to pull out all of our invested capital from us and our partners in the deal. Okay, so now what that does is that it allows you to, of course, get all your money back owning the property, at zero cost to you. Okay. Well, not technically zero cost. Okay. But you don't have your invested capital in it. We're still doing our conference calls. Okay. We're still taking our time to, operate it and make sure it's going to, run smoothly. But we have cheap, long-term debt. So we have debt at, in the 4% range, but for a 20-year term. So that means for 20 years, okay, that debt isn't going to change. Okay, so we can own that property now for 20 years. We're going to cash flow it. And Seth, do you think maybe in 20 years, maybe the rents might go up?
Yeah, maybe just a little bit.
Maybe a little bit, right?
Yeah.
uh, and values and all that. Sure, they might go up, So, but so on that deal, initially when we bought it back. It was in 2013. Okay, and I remember 2013 very very clearly because it was um, just just prior to that, or just around that period, that real estate prices in California spiked. And it was like, just, a year before that, you were still able to, find properties pretty reasonably and cash flow, probably in the low double digits, or the high single digits. And right around, late 2012, early 2013, it's like somebody flipped the switch and boom, multiple offers everywhere. And it was just so immediately, it was, it was just a head turner there. So we were fortunate enough that we bought this property. Okay. And it's in Houston, Texas, 32 units. They're all 2 bedrooms. Okay. And at that time, there was a really nice value add play. And a value add play is basically a component in the deal that allows you to increase the value. Okay. And it could either be on the income side that you can increase the income, and maybe on the expense side that you can decrease the expenses. On this particular deal, the rents were substantially lower than the market. Okay. And as I was studying the market and the general area where it was, I could see that it was kind of in what was called a path of progress. Okay. There was when I was driving around there was a Chase Bank that several blocks down on one of the main drags was opening up. And this was back before Chase. Now Chase is everywhere. I mean, there's like 2 Chases that are like, 10 minutes away from me. Now they're just everywhere. But back then, and it wasn't that they were moving into a building. They were actually building a brand new building for Chase Bank. So, when I see something like that, that excites me because, banks don't move just, into certain areas just because they feel like it. Okay. They're definitely doing their homework. And so that told me that something was going on in that market. There was a growth that was going to happen in that market. I also knew that there was a new high school that had just been built. And it was just opening up, like blocks away from this particular property. And I saw that there was some condo complexes that were getting kind of built very close by. So I could tell that we were kind of in that path of progress. If we stayed where we were, it was eventually going to reach us. So I felt good about the location. We were very close to the downtown, and in many downtowns across the nation right now, it's become very desirable to live close to the downtown because you have this kind of urban lifestyle that's been very popular. But there's been a demand for housing that's close to a lot of entertainment activities and things of that nature. And in the city of Houston, you got your Houston Rockets. You got the Houston Texans football teams. You got the Astros, and the downtown. It's a really fun downtown to be around. So, so the location was very favorable to us in that situation. Getting back to that value add, I said about the rents. We knew that the rents were anywhere from like $50 to $100 below market, and so we put a schedule together that we were able to see, okay, when these rents were going to be expiring, or not necessarily expiring, but when the lease term would expire, and then we would renew them. And then, so we kind of created a schedule as far as, okay, what would you expect to do there? But it was such a growth market that the demand for rentals, we were actually able to achieve what we projected we would achieve in a couple of years. We actually achieved those rents in about 18 months.
Nice.
So that was awesome. Yeah, so that was great. So I mean, it was just more cash flow for us and our partners. We did wind up replacing all the roofs in the building. And that was the other thing that also worked in our favor, is that we had an abundant amount of cash reserves from the get-go. So that's something very important to have an adequate amount of cash reserves when you acquire the property, so that then you can make these improvements over time. With the cash reserves that we have right now after the refinance and all that, our future plans are to start replacing some of the windows and making it a little bit more energy efficient. So so when we bought it back in 2013, we bought it. It was $650,000 for 32 units. Comes out to just a little bit less than $22,000 per door. It's a pretty good price. Only distressed properties now sell for that price nowadays.
Yeah.
And back then that was not a distressed property. So so it was a good deal. We did good negotiations on it, and we had a 5-year loan with Wells Fargo. So the term of our loan was up, and then at that point you either have to decide, are you going to sell the property or are you going to refinance it? Okay. If you're going to refinance it, though, you have to take into consideration certain things. Okay, you're going to be putting more debt on the property. More debt on the property is going to, it's going to hurt your cash flows. It's going to ding your cash flows. Okay, so we kind of had to see how that extra debt was going to affect the cash flows, right? So we just did an analysis there. the good thing was that with the existing the existing loan that we had, it was not we never had an interest only period from the get go. It was always principal, so we were able to knock down a good chunk of the principal balance on that loan and create and have equity there. But the we bought it at 650. It wound up appraising for 1.5 million.
Nice.
Okay, so we had huge equity there, right? So, okay, so we looked at, but we didn't want to max out the loan on this thing. Okay, we didn't, or at that point we didn't know what the effects were going to be. So we kind of had to see, okay, what was going to be the monthly payment and all that, and how it was going to affect the cash flows. And so what we wound up finding out is that rents were still on the rise. We still had some rents that were still kind of, on the lower end that we could still kick up. And we still had adequate cash reserves to make improvements on it. So considering all those factors and what the debt load was going to be, the payments on it, we said, yeah, it makes a lot of sense for us to, refinance it. We'll put more debt on it. It is going to hurt our cash flows, but it's going to be we will be able to bring it back up to what the previous cash flow was, because we still had room to raise rents there over time. So looking at all those factors, it made sense for us to refinance then. Now we could have sold the property and, realized all that equity, but then we would have had to place that equity somewhere. We would have also had to take, capital gains on that as well, right? Unless we do a 1031 exchange. But then we would have to find a property, and that's something that was going to cash flow as much as that property in this environment where we're arguably in a seller's market now. It just made sense to build long-term wealth, hold this property, we'll keep it, put long-term debt on it, and then we'll figure out what we do with it in 20 years.
Yeah, I'm really glad you shared that deal, because you talked about location, knowing your location. You talked about having the right type of debt. You talked about the differences between leveraging the property again and the impact. So you had lots of really good messages for the viewers. So thanks for sharing that.
Absolutely.
Yeah.
Absolutely,
So
no problem.
how has real estate changed your life so far?
Okay, well, I mean, just from a lifestyle perspective, I mean, I'm able to really just do more of the things that I like to do. I just got back in town here from Taiwan. I was in Taiwan and Japan. I was in Taiwan for a friend's wedding out there. So that was really cool to be able to have the ability to do that. Spent a little bit of time in Japan with some family members out there. And so those are the sorts of things that real estate has really allowed me to do. I like going snowboarding as well. And, being a business owner, I'm always trying to make myself better, because as I make myself better, I can help make my company better. So, I also do things. I go to a Toastmasters meeting. I go to many educational events. I'm always trying to improve myself, improve my business acumen. But the thing that I always hated when I was working my job for many, many years was fighting traffic to get down to Irvine, California, because that's where I worked at. And man, that morning, I remember the morning traffic, when I was first working out there back in oh my God, this is like back in the 90s. Okay. So I'm a pretty old dude now, but geez, I remember, you drive down there, you get to my job, hopefully in 30 minutes, that's manageable. But then 30 minutes turn to 40 minutes, 40 minutes turn to 45, then 50 minutes. And then, somebody gets in an accident and, you're going to be there an hour minimum, and I just hated that drive time, that waste of time sitting in the car, going in the morning, hitting the alarm clock, hearing that alarm clock go off, and then coming back, fighting the traffic. I just hated that whole routine.
Yeah.
Loathed it.
I don't blame you at
Now I
all.
still, no, I mean, I still get up, I still do those things, but I have a much shorter commute. I've been able to, um, build my life for, I'm like less than 10 minutes from my office here. Okay, so that's great. I still have to be here for my staff and take care of them. But if I have to take care of some personal things or whatever, hey, that's for me to decide to do. If I have a family member that needs help or whatever, it's not a problem. I have a friend who's getting married in some other country across the world. Great. It's a new experience that I can have with a close friend.
Yeah. No, that's great. So, Omar, if somebody's looking to get in touch with you, learn more about what you're doing, maybe invest with you, how can they find you online?
The best way is through my website, and that website it's LaRueInvestments.com. It's spelled Leru, then investments with an S at the end.com. They can also email me, Omar@LaRueInvestments.com. And we also run one of the biggest real estate investor clubs in Orange County. It's called the Orange County Investment Club. We meet every month in Irvine, California, right across from John Wayne Airport at the Irvine Hilton. And there we always bring speakers that have knowledge in a lot of different things. I had a couple of ladies that were knowledgeable in self-storage. I brought fixed and flippers. And I had a Leo Clark, who's a developer. He came down. He spoke at the last event. Joe Lahori, who's also a founder. He's in mobile home investing, so he's going to be speaking. So that's a great club where people can get education and network with like-minded individuals.
Yeah, oh, for sure. And I'll make sure we include the links right down below so people can just click on that.
That's great. Appreciate that.
Yeah. So, Omar, just want to say thanks so much for taking the time and sharing your success with us.
Absolutely. Thank you very much, Seth, for having me, and I wish you and your audience great fortunes.
Yeah, it was my pleasure. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.